and welcome to all for this call on the update on the Greater China region. Over the last few years, this region has generated almost 15% CAGR, which is the underlying fund, JPM Greater China Fund. Over the last decade or so, this theme has generated almost 16% CAGR return and has consistently outperformed its benchmark. However, if you see over the last 1 year, or specifically over the last 6 months, the theme or the region has gone through some volatile market conditions. And many of you on this call, I believe, would be existing investors and wanting to know what actually is happening in the region and what should we do with your existing investments, or whether we should invest more in this theme. Many of investors would be having existing SIPs in this fund. So today we have with us Supreet Bhan, who is the head for Asia region JP Funds. And he's going to take us through what's happening in China, what are the opportunities, what are the risks, and more specifically, what's happening in the China region over the last few months, and what's happening in the fund too, which is the underlying fund. So what we're going to do is Supreet is going to run a short presentation of 30-35 minutes, and post that we'll try to take as many questions from you all and try to address as many questions we can. So thank you for joining, and over to you, Supreet.
Good afternoon, everyone, and thank you very much for your time this afternoon for joining this discussion. I want to start by thanking Edelweiss for the opportunity to come and speak to you all this afternoon, but most importantly for you all to make your time. I do realize you'd be busy. This is a busy time of the day, and obviously this is a weekday as well. So really appreciate you making time to join this discussion. As Niranjan gave you a little bit of a background, what I intend to do through the course of the next 35 minutes is really to give you a little bit of a background on what really has been the key catalyst or the context of the recent regulations. Hopefully, if I've been able to do that, I'm going to try and tie that into those specific regulations and some of the developments that have happened, particularly over the last couple of months. And finally, in the final segment of my presentation, we will speak about what are the long-term opportunities within this exciting region of the Greater China region as well. But before we launch into the presentation, let me give you a little bit of a background. The Greater China Fund of JP Morgan Asset Management is investing across 3 main markets: China market, obviously, Taiwan, and Hong Kong. But for bulk of our discussion today, since Niranjan's alluded to a lot of the noise that's been coming out, we will spend a considerable period of time just discussing the developments around China, but I'll be happy to take any questions that you have on any of the other 2 markets as well. So with that, let's just dive into the first agenda. But before I go there, and Niranjan gave you a little bit of a background about the last 10 years returns. This fund of JP Morgan is more than 20 years old. So let me take you back in time. First of all, on this slide, what you see on the left-hand side is that in this decade of 2020 till 30, China will become the largest economy in the world. It is currently the 2nd largest. By 2030, it will become the largest economy in the world. But more importantly, on the right-hand side, what you see is on the y-axis, real GDP per capita, which is widely recognized as a measure of prosperity of a country. And I want you to focus on that red line or dots. And we've pointed out 2020, which is the closest number, essentially to highlight that China over the last 20 years has moved from being a low-income country to a middle-income country. The real GDP per capita currently for China is about $10,200, pegging it in the middle-income category. And we all know why it's been able to move its wealth to middle income. It's largely because it's been a manufacturing hub of the world, and it's grown fast as well. But clearly, the aspirations of China and Chinese markets haven't ended there. In our lifetimes, they're aspiring to move from being a middle-income country to becoming a wealthy country. And for context, we've shown you some of their wealthy peers, like South Korea, which is an Asian peer, and also another country which feels like they're being competitors to United States, which is the US and China, and the competition the 2 markets are facing. So very simply put, What's got China where it is today is not what is gonna take it to its aspirations of becoming wealthy. So if you go to the next slide, I'll try and put in context the last 20 years. On the left-hand side of the slide, you see the era of 2000 till 2010, the 10th five-year plan and the 11th five-year plan. And as you move towards the right of the slide, the more recent one, and the most recent one being the 14th five-year plan, which is on the extreme right. But let me walk you through each one of them and try and draw a contrast which will tie into some of the developments that are taking place. At the start of 2000s, the objective of China was to alleviate poverty, to grow from a low income status to a middle income status. So clearly the objectives that you notice in the 10th or the 11th five-year plan, which was the decade of 2000 till 2010, was quantity of growth. 7% real GDP growth, 7.5% real GDP growth, external demand, external competitiveness. But as you transition towards the current time, and I bring your focus towards the 14th five-year plan, you notice that there's a shift in their approach and the focus. The focus has shifted from quantity of growth to quality of growth. And let me elaborate on that. In the 2000 till 2010 and perhaps till 2015, the focus was on external demand or exports, which is why many of us in India feel that China is the export hub of the world. China also focused in that period of time on investment. The other area of focus was manufacturing because it wanted to be the manufacturing hub of the world. And finally, it was focused more around low-tech, almost textile manufacturing in that period of time. Fast forward to the current times, the focus has shifted. It's no longer external demand which is focus, it is internal demand which is of focus. While investment was focused in the 2 decades back, the focus now is consumption. Similarly, manufacturing was the focus 2 decades back. Clearly, focus on quality means that they're going to focus on services. And finally, if they were known globally for manufacturing low-tech products in the decade of 2000 till 2010, their aspirations are really to be the manufacturers of cutting-edge technology going forward. So that's the first distinction that I want to make between China, which existed perhaps 10 years back, and the China that is there today. Remember, not quantity of growth. So you don't see any GDP targets in the 14th five-year plan, but indeed quality of growth. But if you do focus on the text under the 14th five-year plan, you start noticing there is another focus, and that focus is around not just quality of growth. One of the subsets of quality of growth is quality of life of their citizens. Quality of life is defined by the Chinese government as common prosperity, reducing inequality, and finally, also reducing environmental degradation, just tying into that quality of life. So staying with the theme of shifting focus, the focus of the government is on these 3 parameters of quality of life, which remember, common prosperity, reducing inequality, and reducing environment degradation. But on the flip side, what they've de-emphasized or defocused is really areas around real estate, infrastructure, which were honestly challenges to this ambition of quality of life. Why challenges? Because if real estate prices continue to go up, if you follow the data in several cities in China, the affordability is just off the charts. In certain cities, value of an apartment is almost 40 times the median annual income of their citizens, essentially taking away from that quality of life where aspiration of the population is to own properties. So try and soak all of this information up, which is essentially around quality of life, quality of growth, quality of life being one of the means towards that quality of growth as well. So with that, let's now try and tie in some of the regulatory developments that have hogged the limelight or the news over the last 2 months. But I have to tell you that the beginning of this era was 9 months back, which is when Alipay came into the crosshairs of regulators at that point in time. So while the frequency of news announcements have gone up in the last 2 months, this really was set in motion about 9 months back. So let's focus on what has been the area of attention for the regulators. Inappropriate use of market power, which is, in simple terms, monopolistic practices. Remember that objective of reducing inequality and common prosperity. Monopoly damages customers or hurts their employees, and also hurts small and medium enterprises. A good case in point is the action that was taken on Alibaba for the alleged monopolistic practices, which is essentially, if you want to list your merchandise on Alibaba's marketplace, you have to be exclusive to them. You can't list on any of their competitors' websites or marketplaces. That damages that objective of reducing inequality and common prosperity. Therefore, that monopolistic practice was penalized. Also, exploiting gray areas in regulations or regulatory goals like fintech, which is honestly why Alipay came into focus as well. And the objective really here is to protect consumers. Again, tying into that objective of common prosperity and the quality of life objective as well. And if you think about it, these objectives aren't necessarily different from the objectives of the regulators in the West as well. Let's look at another one. Let's take another example. The third point, monopolist behavior, essentially mistreating your employees or your gig workers. What are gig workers? People who are working as delivery boys or just temporary workers who work on a gig basis as well. So treatment of drivers as well. Again, tying into that quality of life or inequality. And the focus here was Meituan, which is the leading delivery company in China, where allegations was not enough wages being paid, not enough insurance being covered, in the case of any accidents as well. So very similar again to what we've been hearing in the West. And finally, control and use of data. Where is, first of all, the data being stored? What is the use of that data? Because ultimately, data could be power, and the intention here is to protect consumers. Now, this is something which I know that even regulators in India feel very strongly about, which is why there has been news around the ability of some of these foreign e-commerce players being able to host consumer data offshore in their cloud computers or cloud software or cloud service, instead government asking them to host it onshore. It's the same in the US. It's the same in other parts as well, like Europe. The difference really is that the Chinese regulators have been behind the curve. So while most of the regulators have been doing this over a period of time, including the Federal Trade Commission in the US, the Chinese regulators, you could say, have been behind the curve and playing a little bit of a catch-up at the moment as well. So why now? Essentially, why are they behind the curve and why are they doing it now? Well, honestly, they had a very strong 2020 compared to the rest of the world. And therefore, from an ability of the markets to absorb this, if there was ever an opportunity to do this, now is the opportunity. You can't do this when the markets have been weak. So 2020 was a strong year for capital markets for China. As I mentioned, rising inequality and the K-shaped recovery, which essentially means few people have become billionaires, but most of the people haven't participated in the recovery as well. And clearly that inequality is something which the government is quite concerned about. This is a politically significant year. There are elections in March and April of the next year. For political survival of the Communist Party of China, it is important for them to ensure social harmony. Let's go to the next page and try and spin that into what is the end game. Remember what I said, political survival is dependent on social harmony. So social harmony and financial stability are the first principles for the Chinese government. A level playing field is important for the larger objective of the Chinese economy to become richer, because they want to drive innovation, and competition drives innovation. What they want to do is to set a level playing field that stimulates innovation. We all know and we are aware there are geopolitical tensions, particularly trade tensions between China and the US, and really reducing the dependency of Chinese on US markets with regards to listings, and therefore expect more listings to take place either on the Hong Kong Stock Exchange or on the onshore China Exchange as well. Now, if you take a step back, if you soaked up all that I've said in the last 10 minutes, which is quality of growth, leading to quality of life, common prosperity, reducing inequality, and finally reducing environmental degradation, all of these objectives are not anti-capitalistic aims. They will, over the medium to long term, act as guardrails to encourage and stimulate innovation and entrepreneurship, not to stifle it. Now, with that being said, let's admit it, we are not a passive investor. JP Morgan Asset Management, the Greater China Fund that we bring to you through Edelweiss Greater China Fund, is ultimately an active portfolio. So how do we deal with the noise and the developments that are taking place on the ground? Clearly, we're running a portfolio. If we don't like it, we don't need to own it. So we don't run just a concentrated list of stocks. There is a diversified portfolio of 63, 64 stocks in the portfolio. We ultimately bottom-up fundamental stock-driven, which is essentially trying to identify the best ideas. And if the investment thesis changes for any of those best ideas, you can resize those obvious areas of sensitivity. Also, not all regulations impact all companies equally. Whatever you've seen in the top half or in the previous slide is essentially the government trying to push a balance between the economic goals of internet companies and social goals of the CCP. What the message clearly, which has come out over the last 9 to 10 months of these regulations, is that the government clearly is not okay with these companies just driving hard at their economic goals. They need to strike a balance between economic goals, which is what you and I are interested in, and also the social goals, which is that of quality of life as well. Within that, there are clearly sectors that get impacted a lot more than some of the others. For instance, you would have read about this. Education technology, which became pervasive in the Chinese economy, where it no longer was a discretionary consumption or a discretionary expenditure, and almost became a mandatory expenditure for parents, leading to deterioration of that quality of life. Raising a child became expensive, which challenges that social harmony, that social balance, which the CCP aspires for, leading to a very swift and decisive regulation, which essentially made this sector uninvestable. The good news in our portfolio, we did not hold any education technology stocks. But at the same time, there are companies which are able to embrace and adjust to these changes a lot better than some of the others. And our ability to be on the ground with a team, with a very strong team of research analysts and portfolio managers, we are in a lot better situation to identify those companies which are indeed able to embrace, adjust, and still prosper in this environment as well. And honestly, is able to find that balance between economic goals and those social goals as well. Clearly, over the last 2.5 months, there has been a significant deterioration in sentiments around Chinese equities. But there isn't a commensurate or symmetrical deterioration in fundamentals of most stocks. When that happens, when there is an anomaly between deterioration of sentiments and deterioration of fundamentals, it usually means that some long-term great businesses are available at a much better bargain than before. And we have used this opportunity in recent times to identify those businesses where this recent deterioration of sentiments generally around Chinese equities has led to correction in those stock prices, but there hasn't been a commensurate deterioration in those fundamentals, which is a buying signal for us. And we've used that opportunity to build into our portfolio at in those levels. Ultimately, whatever I've spoken about, it's not something which is new to China, which is volatility. While the 14th five-year plan has laid it out, the first signal of that came in 2018. So if you go to the next slide, you will notice, and this is MSCI China benchmark that we are showing here, which is not the benchmark for our strategy. But nevertheless, since the discussion is on China, we thought MSCI China would be the best proxy for that market. The benchmark for the JP Morgan fund is the MSCI Golden Dragon Index. Let's stick with this. The current market correction is about 32% for MSCI China, which is slightly more than the correction in 2018. 2018, the correction was again because of regulations around tech and also drug pricing, so healthcare. Again, remember, going to tie into quality of life because healthcare is an important aspect of it. This happened 3 years prior to that in 2015, which had nothing to do with regulations, but really around leverage in the Chinese stock markets, essentially driven by retail investors in China. As they delevered, markets fell 40% in China. And finally, in 2011, which is the last time, 10 years back, there was concern around debt in China, very similar to the noise that you're hearing today, and which is when the markets corrected again 30%. So these drawdown periods are not new. Coincidentally, they've happened in a frequency of 3 years over the last 10 years. But the interesting thing is, past that noise, and I know it's difficult when you're living through it, but past that noise 6 months out, which is shown by the green bar graphs, on an average, after those drawdowns, 6 months down the line, the Chinese markets have delivered a 20% positive return. Just showing you that in many instances, these aren't structurally disruptive of the fundamentals of the Chinese economy, and very often lead to buying opportunities for investors who have a long-term view. Just tying into that comment that I made, which is around deterioration of sentiments, which has led to this level of correction in the stock markets, but not necessarily an equal amount of deterioration in fundamentals. The next slide will show you that. I apologize, that's a busy slide. I don't want you to read the text. All I want you to do is focus on the green highlighted text. This is Tencent, one of the leading diversified internet companies in China. Their revenue and profit growth expectation over the next 4 to 5 years is 19% annualized and 23% annualized respectively. In the bottom half of the slide, we're showing you the growth in their revenues. As you can see, it's a diversified business across gaming, value-added services, advertising, and fintech. On the right-hand side, we're showing you the growth in expected profits. These are our fundamental research after pricing in the kind of adjustments that we've done to the fundamentals as a result of these regulations as well. Tencent today is trading at valuations last seen 8 years back. The stock price is trading at a level which was last seen 2 years back. Its e-commerce rival, Alibaba, is trading at a stock price which was last seen 3 years back. Just for you to soak up that information. So remember, as long as the deterioration of sentiments is not the same as the deterioration of fundamentals, and the fundamentals haven't deteriorated that much, often that is an opportunity to buy great long-term businesses. And indeed, we've done that in our portfolio as well. I know I've covered a fair bit of ground. Let's try and summarize this for the first segment. So what is the key takeaway? Let's put regulations in context. The aspirations of Chinese regulators is, in our lifetimes, to move the economy to be a high-income nation. What they're doing is putting guardrails in place for long-term development of that quality of growth, and essentially are catching up with some of the Western practices. And of course, China is unique because the focus areas being that quality of life and reducing inequality. Government's attitude towards internet has moved from being lax to being more stiff. Again, as long as those companies can strike a balance between economic goals and social goals, these companies should be fine. And finally, as I've expressed over the last 5 minutes, there are opportunities opening up for long-term investors. It's not going to be a straight ride. It never is in stock markets. Chinese markets are emerging markets, and therefore will tend to be volatile through that period of time as well. So hopefully I've been able to contextualize a lot of the regulations. Let's address, before we go into where are the opportunities, let's address what's been hogging the news since last Friday, which is around the real estate discussion which has been going on. Now, at JP Morgan Asset Management, our view is that the base case is that the government will orchestrate an orderly restructuring of debt of these real estate companies which are under stress, particularly the one which has hogged the news of late. In our view, again, our base case, we don't think it's going to lead to a contagion to the broader economy. It clearly will have an impact, even if there is an orderly restructuring of the debt, which seems like the most likely scenario if you've been following the developments over the last 24 hours. Even then, real estate as a sector will be under stress. What will also happen is that the lenders to those real estate companies, which are typically your state-owned banks or public sector banks, will tend to underperform in that period of time because their NPLs will go up and they'll have to restructure those loans as well. In a lot of ways, analogous, not similar, nothing is ever identical, but analogous to what happened to IL&FS in India, leading to pressure on the NBFCs, while the real economic activity around the most exciting parts of the economy weren't impacted for the long term. Our base case is that Evergrande will go in for an orderly restructuring of its debt. There will be haircuts that will be taken by some of these state-owned enterprises, but we don't expect a contagion. We do not expect a Lehman kind of a scenario, which has widely been, I understand, written about in the press and on social media in India. That is not our base case. Of course, never say never, but the probability of that event is likely very low, in our opinion. As I mentioned, the likely impact is on real estate and those state-owned banks. The parts of the economy that I will go to, which is the most exciting part of the quality of growth of China, in our opinion, will be insulated from the impact of these events. Also, remember what I said, it's a politically important year. Going into elections next year, the government wouldn't like to see a debt event lead to a contagion which has an impact on the economy, which will erode political capital, which will erode away from their aspirations for that social and financial stability, which, remember, are their first principles. All right, enough said about all the bad news. Where could potentially be the good news? So let's go to the next slide. I mentioned to you that the current focus is around cutting-edge technology. And the chart on the left-hand side is showing you the growth in the number of patents from Chinese businesses over the past 10 to 20 years. You can clearly see that today, they are the global leaders in terms of patent applications. On the right-hand side, again, since I started 20 years out, back in history, 20 years back, China was not spending a significant amount of its economy on research and development. Today, the Chinese economy is $15 trillion, so it's a much bigger economy than 20 years back. And they're spending 2% of their GDP just on R&D. And why did I bring this slide up? On the left-hand side, today's patents are tomorrow's innovation. On the right-hand side, today's R&D spend are future earnings of these companies. So that's important to highlight. And let's go to the next slide, which is an example of how technology is really driving even important sectors for the future, like electric vehicles. Now, the biggest market for electric vehicles is China. Today, 6% of all the cars sold in China are electric vehicles. Over the next 4 years, it's expected to go to about 25%. So 1 out of every 4 cars sold by 2025 will be an electric vehicle. It's not just going to benefit Tesla. There are Chinese companies building electric vehicles for Chinese consumers, and also the supply ecosystem, like battery providers, like charging connectors and so on. So just thinking about a mass addressable market like electric vehicles, you realize that Chinese are the biggest consumers of electric vehicles, and people who are or companies that are going to benefit aren't just going to be American companies like Tesla. They're very likely going to be companies such as XPeng, as well as NIO and Li Auto, which are really driving innovation within electric vehicle space in China. Similarly, on the next slide, it's important to recognize that the world is focused on addressing climate change. On the left-hand side, we're showing you that China is currently the largest emitter of greenhouse gas emissions. Their emissions are twice the emissions of the US. And for a simple reason, because the Western world has outsourced its manufacturing to the East. So all the manufacturing is now in Asia, and therefore, the carbon footprint of Asian countries seems to be higher. Nevertheless, while US and Europe have committed to a 2050 carbon neutrality, China has actually committed to 2060. Really ambitious. But that's going to happen by reducing dependency on fossil fuels and moving more towards renewables, battery power, solar, and wind. So if you go to the next slide, I want to emphasize, again, this is the interesting part of China. China today is a global leader in the supply chain of solar power. Whether it's polysilicon, solar glass, wafers, all components of a solar farm, they have anywhere between 70 to 90% share globally. And we own two stocks in our portfolio, a stock called Longi Green Energy, which is the largest producer of wafers globally with 60% market share, and Tongwei, which is the number one polysilicon and cell producer globally as well. So again, China is interesting because of technology. It's also interesting because of the world's transition towards cleaner sources of energy as well. For the final segment, let's tie that into where in the Greater China Fund are we finding opportunity in this market or region, which is aspiring to become a rich country, a rich market, and is also innovating and frankly has a vast population, which is now middle income status, and they've alleviated poverty. Enough said about technology. The one other area that will benefit when you have a vast population, which is now affluent, is healthcare. Because if you don't have to worry about spending on staples like food, water, and housing, you will take better care of yourself. Therefore, Chinese consumers spending more on healthcare will benefit Chinese businesses. And the same applies to consumption. When the population becomes more affluent, they consume better commodities or better brands of the commodities that are available as well. So if we go to the next slide, let's now try and bring this home in terms of what we own in the portfolio. Having spoken about technology, it'll not be a surprise to you to see in the top half of this slide that almost 1/3 of our portfolio is in information technology. It's not just Chinese information technology. TSMC, Taiwan Semiconductor, the best semiconductor company in the world, is the largest holding in our portfolio. So out of that 32%, 10% is sitting in TSMC. The other area of focus for us, as I mentioned, is healthcare. So that's an overweight in the portfolio. And of course, consumption as well. So a name like Tencent, MSCI categorizes as communication services, but is honestly a consumer business, a consumer internet business. Where we are underweight is towards the right-hand side. Since I spoke about Evergrande, good to point out, the portfolio did not have any allocation at all on Evergrande, ever. The allocation to real estate is just 2%, and that's not a real estate developer. It's a property management company by the name of Country Garden Services, which is frankly aligned to this goal of the government of common prosperity, which is around property management, providing care services for the elderly, care services for children while the parents are out to work, essentially towards managing residential properties and just enhancing the quality of life for the residents as well. They've also been very instrumental in rolling out the aggressive vaccination program of the government by ensuring that the COVID vaccinations are rolled out in the properties that they manage. So they're a property management company, not a real estate developer. The other area which I mentioned is a likely area of getting impacted, which is state-owned enterprises. We are underweight on that. So financials, which is where state-owned banks sit, it's a big underweight in our portfolio. What we tend to like are private banks, private financials, like a Ping An, which is like the HDFC Bank of India, or a Hong Kong Stock Exchange, which is like an NSE of India as well. Bottom half is showing you the country allocation. 64.5% is in China. About 8% is in Hong Kong stocks, which are Hong Kong companies listed in Hong Kong. And Taiwan is about 27.5% of the portfolio. Finally, let's very quickly walk through some of these opportunities that we reflect in the form of our expectation of earnings growth. Ultimately, over the long term, the biggest driver of stock prices is earnings. In the short term, the drivers could be news, it could be regulations. Over the long term, the biggest driver are earnings growth. For your benefit, we've highlighted the 5-year expected growth of our portfolio, which is at 18.5% annualized, compared to the benchmark at about 14.7. So if our thesis is right, if earnings per share growth is a good guide to the movement of stock prices over the long term, that's the handle that you need to bear in mind as well. I would just want to focus as a final slide on the performance of the underlying fund. Niranjan, in his opening comments mentioned this is an existing fund in India for the past 12 years. Well, in reality, the master fund, the JP Morgan fund, was incepted 20 years back. And since launch, in those 20 years, as I've walked you through that period of time, it's delivered in US dollar terms, not in INR terms, in US dollar terms, 13.3% annualized growth in that period of time. 5-year returns, again, US dollar, it's not benefiting from the rupee depreciation, 20% compounded annualized, and 3 years, 23.7%. 1 year is still a modest 16.37. Year to date, and particularly the last 6 months have been rough, and the last 3 months, which is when the regulatory action has picked up significantly, the fund is down about 10.3% in that period of time. I also want to bring your focus to 2018 as the calendar year, which is in the bottom half. Remember what I showed you earlier? The regulatory action happened in 2018 as well, which is when the fund was down 23% in the calendar year. But bring your attention to 2019. The fund was up 44%. Again, tying into the comments that I made earlier, which is for those who have a long-term view, some of these corrections can lead to an opportunity as well. Why don't I just go to the slide on the team and just emphasize that ultimately, when you're looking at this portfolio, you're not investing into a passive fund. You're not investing into, and let's go to slide 21, which is on the team, which is showing the JP Morgan team which manages this fund. You're ultimately investing with a team which is on the ground. These are Chinese people present on the ground in Shanghai, Hong Kong, and Taipei, who are doing this grunt work of doing fundamental analysis and finding the best ideas from a very important market. Remember, Chinese stock markets or Chinese capital markets are the second largest capital market in the world today. And therefore, having these people on the ground is instrumental towards that fundamental bottom-up stock selection as well. And hopefully, through the track record that I showed to you, what comes out is that the secret sauce towards that strong performance is really these people who are doing that hard work of identifying the winners and staying away from potential mines as well. Let's bring this all together and summarize. And I look forward to your questions, and I'll hand it over very soon to Niranjan to moderate the Q&A session. Ultimately, if you followed whatever I've said over the course of the last several minutes, Greater China region presents a multi-year growth opportunity. And the recent volatility has created some really attractive valuation opportunities for the long-term investors. It is going to be a bumpy ride. It's never a straight line. Volatility is one of the certainties of life. It needs to reconcile to it. Diverse set of high growth opportunities exist across sectors such as technology, healthcare, consumption, all of them tied into the long-term objectives of the government there. And finally, the JP Morgan Greater China Fund is a portfolio of high conviction ideas, which are growth and quality oriented. And ultimately, even from independent agencies like Morningstar, has a 5-star rating, as well as a silver medal rating, and has won numerous awards as well because of its long track record as well. With that, why don't I pass it back to Niranjan, and I look forward to your questions as well. Thank you.
Thank you, Supreet, for that insightful session. I believe there were a lot of questions amongst the investors around what's happening in China, and we've tried to address them. Thank you so much, Supreet. However, there are a couple of questions as well, and as we go forward in the presentation, we'll try to address them as well. One of the questions is basically around, so as you mentioned, Greater China is a region comprising of Hong Kong, Taiwan, and the mainland China market. One of the questions is the fund has been overweight on the mainland China. And that's the real story which is being unfolded. What is the stance in the underlying portfolio? And with this regulatory stuff happening in the China, is there any change in the overweight position on the mainland China market?
Thank you for the question. A simple answer is no. We continue to be long-term bulls on the Chinese stock markets. And as I mentioned in the earlier part of my presentation, some of these deterioration sentiments have led to some interesting bargains in what are great long-term businesses, where they're available at valuations which are a lot more attractive than they were 9 months back. So our thesis over the long term for the potential and opportunities within mainland China haven't changed. On the margin, stock pickings would have changed. I can share with you that going into the new year, which is 2021, in the Q1, in first quarter, which is Jan till March, we did own education technology stocks in the portfolio. But thanks to our bottom-up stock selection and fundamental research, and thanks to those individuals whose mugshot I'd just shown you just a while back, right, the red flags compelled us to exit those stocks. And the red flags were exactly around the inability of that sector to comply with the aspirations of the government of prosperity and reducing inequality. And we exited those positions in April, which is why when the event took place in reality a couple of months back, we did not have any holdings in our portfolio. Instead, we used that capital that we raised by liquidating that stock more towards some other interesting opportunities, either in healthcare or in technology, names such as Tongwei as well as Longi Green Energy, which are great market leaders within the solar space as well. So in summary, our optimism over the medium to long term on China hasn't deteriorated. Of course, stock pickings have been adjusted because, as I mentioned, there will be some businesses which will adjust, embrace, and yet prosper after these regulations. Conversely, there will be businesses which will most likely not be able to adjust to these as well. And our fundamental research is the main driver of those decisions.
Taking cue from your answer on the valuation, now there are a lot of questions around valuations as well. And I believe many markets, including India, are not trading cheap anymore compared to what they were trading probably last year. However, in case of China, I look at some numbers in the deck, and maybe you can refer to them. The valuations, and you also mentioned on stock level basis, the valuations have become attractive. So at the portfolio level, how is the portfolio valuation looking at compared to the benchmark, and what are the future earnings prospect and the quality of the earnings quality of the portfolio expected?
Once again, thank you for that question. So let's take two sets of numbers. Let's look at China alone. Since I looked at MSCI China to show you the previous periods of drawdown, MSCI China, Niranjan, today is one of the rare markets which is trading at a discount to its 15-year price earnings average multiple. It's a rare thing in today's world. For instance, most of the other markets are trading at a premium to their 15-year multiple. But I pointed out, our portfolio is not benchmarked to MSCI China. Also, in MSCI China, you will find a lot of these old economy companies like state-owned banks, infrastructure companies, real estate companies, which we just don't own in our portfolio. What we own in our portfolio are quality companies. As I mentioned, it's a quality and growth-oriented portfolio. And today, the benchmark is trading at a PE multiple of 23.4 times forward PE multiple. The price has dropped, but we've had to adjust earnings outlook as well. The last time we did this call, along with a colleague of mine, the 5-year expected return was in the range of about 21 to 22% annualized. Clearly, given the regulatory action, our outlook on earnings has been adjusted, which is why in a PE ratio, when the denominator also falls, the ratio tends to go up as well. So ratio hasn't gone up because the numerator has also gone down. So against a 25, 26 forward PE multiple, it's now trading at a 23.5 forward PE multiple. But here comes a very interesting statistic, Niranjan, which is not on the slide. Debt to equity is a good measure of a portfolio and the quality of the portfolio. How much debt do you have compared to your equity? The debt to equity of the benchmark is close to about 25, 26%. The debt to equity ratio of the Greater China Fund of JP Morgan, this fund, is minus 20%. Many of you on the call would be wondering, what is a minus 20% debt to equity ratio? It means that at a portfolio level, the portfolio is cash rich, it's cash surplus. Not every company is cash surplus, but at a portfolio consolidated level, there is net positive cash. So if the recent developments around Evergrande real estate have been concerning, if your concerns are around debt, cost of debt going up, this portfolio is actually insulated to that extent because at a composite portfolio level, it is cash positive. But these are some of the important numbers. And finally, to your question, Niranjan, the 5-year expected growth has been reworked, even despite all these fundamental changes, which I've been referring to over the course of the last 40 minutes. It's still a healthy high teens, 18.5% compounded over the next 5 years.
Thanks, Supreet. Now coming to another pertinent question is around the US-China trade war. While people have forgotten it over the last 6 months because of what's happening in China, but that worry, keeps coming into the mind of investor. So what has been the development on that front?
It's absolutely a risk that you always must bear in mind when investing into the Greater China region, particularly in China. The one thing that the politicians in the US on both sides of the aisle, Democrats and Republicans, agree on is that they don't want to see the world being bipolar. They like a unipolar world where there's only one superpower, both economically and militarily, and also technologically. And that status is being challenged by China. And China clearly has aspirations. If you've followed whatever I've said in the earlier part of my conversation, China's aspirations to become wealthy are being driven by quality of growth, which is economic, technological. So for the foreseeable future, you will continue to see trade wars, geopolitical issues continue to pop up, and that's a risk that you have to adjust to. On their part, China, in order to continue with their aspirations to grow their technological superiority, have started accelerating import substitution, which means they're relying less on the Western suppliers and have actually encouraged local entrepreneurs, local businesses to start manufacturing the entire supply chain of the technology complex. So on this slide, and I apologize, it's a little small, or maybe I need a new set of glasses as well. What you see here is in the red elliptical circle, that part of the supply chain of technology, which China depended on the West for in the past, but because of the trade wars over the past 4 or 5 years, has managed to import substitute, which means local businesses now manufacture this for technology companies. So things such as robotics, office software, integrated circuit assembly, which is a part of the semiconductor universe, wafer cleaning, again, semiconductors, and so laser generator. What they haven't been able to nail is on the extreme right-hand side of the x-axis, which is lithography and advanced wafer fabrication. But guess what? TSMC is the best business in that. And TSMC, by virtue of being a Taiwanese company, as I mentioned, is the largest holding in our portfolio. So even though it doesn't get captured by Chinese companies, because it's a geographically diversified portfolio across Taiwan and Hong Kong, we have the ability to buy that as well. So the unintended consequence of trade wars or this tension with the US has meant more opportunities for stock pickers such as ourselves, because frankly, there are more businesses which are innovating within China as a result of the trade and the tech wars as well.
Taking this insights further, one of the questions is on semiconductors. So world is feeling the hunger of semiconductor. Now, I understand TSMC is one of the largest player. How much is the overall exposure to the semiconductor, including the mainland China within the tech segment? And if you add the communications segment as per the MSCI, this thing.
So we don't have that breakup because MSCI doesn't break up sectors accordingly. It's in a big bucket of information technology. So if we go back to slide number 14, which is where the sectoral breakups are given. The semiconductor stocks are lumped into this broad category of information technology, which in our portfolio is 32.4%. The benchmark is, we're overweight by almost 9%. So in the benchmark, it'd be about 23% as a total information technology, and a big component of that would be semiconductors.
Okay, sure. Now, one of the typical question from most investors is this the right time to invest in China? Both from people who have not invested and people who are already invested in the fund, and also whether they should stagger it over the next few months or a year, or try to invest at one go, because there's been a good correction and the valuations are quite attractive.
It's a great question, but one that I'm incapable of answering with any level of expertise. But let me take again an example. Since I used the default of ILNFS as an analogy or analogous event to Evergrande, let me also use March of 2020 in the Indian stock markets as an event which I want you to remember in your minds. How many of you can put a hand to your heart and say honestly that I used that opportunity to build positions in Indian equities? Frankly, the news was terrible at that time. If you would have looked at Bloomberg, which is what I look at, and I look at for Chinese markets right now, for Indian markets, it was exactly like that. Indian markets are uninvestable, draconian lockdown. There are not going to be any earnings. It's going to take the country back 20 years and so on. Well, come forward 15 months, I'm sure a lot of those journalists are having the humble pie. I don't know when this happens, but I'm fairly confident there will come a time which when you look back at these events, it's very likely that you look back and say, this is probably an interesting time to build a strategic allocation to the second largest economy in the world, which will become the largest economy in the next 8 or 9 years, which is also aspiring to become a rich nation, needs to be a structural part of my portfolio. I leave that to you and your advisor to decide what should be that percentage in your portfolio. But it would have been a great time because some of these businesses were available at very reasonable prices, in some cases, some bargains as well. With regards to whether it should be lump sum or SIP or STPs, it's entirely on your risk appetite and your horizon. And in that context, let me first of all tell you that if you don't have a 3-year horizon or longer, this is not a fund for you. If you don't have the stomach for volatility, just like volatility in Indian equity markets, this is not a fund for you. If you can reconcile to an investment horizon of 3 years or more, if you can stomach the volatility like you see volatility in Indian stock markets, then you should consider adding this as a strategic diversification in your portfolio. And why do I bring the term diversification? Because Chinese markets are uncorrelated to Indian markets. Remember what was going on last year, March or April. While Indian markets were falling, Chinese markets were resilient. At that time, if you would have had an allocation to Chinese market, your portfolio would have looked a lot better than 100% allocation to, let's say, just Indian equities. Fast forward to present times, Indian equities are on a tear, but Chinese equities are underperforming. That's exactly what you want from your diversification. You don't want correlated returns from your diversification of markets. You want uncorrelated returns so that at a portfolio level, your experience and volatility of your portfolio reduces and your experience is a lot smoother than just putting all the eggs in just one basket. So to me, China would be a long-term strategic allocation in a client portfolio. But again, I emphasize, I'm not an advisor. Please consult with your advisor. Your risk appetite, your allocation to Indian equities, all of that matters. This is not a substitute for Indian equities. It's a diversification. So if you're not adequately exposed to Indian equities, you should first of all consider completing your allocation to Indian equities before you contemplate a diversification. But that being said, It is a very important market. It's the second largest capital market in the world, and really clearly setting the guardrails and a foundation for what is likely to be quite an interesting period, albeit it's going to be a volatile period, just like any other stock market.
Supreet, the one last question before we end is around the FI flows. And one of the important factors for any equity market to do well is also look at how the FIs are looking at the market. One important development over the last few years, which has happened in the mainland China market, is it is now being included in the MSCI emerging market indices. Why don't you touch upon that aspect of, because that is also one of the important drivers of, returns and flows into the Chinese market, mainly the mainland China market, where the fund has been overweight.
Okay, I'm going to take a couple of minutes to explain the background, because that's important to understand the concept here. Unlike Indian stock markets, where once a foreign investor is registered with SEBI as a foreign institutional investor and can start investing and buying stocks, no limits, provided there are no sectoral limits or company-specific limits. In China, you couldn't do that till 2016. Chinese onshore market, which is called the A-share market, had restrictions and quotas. So even if JP Morgan would register as a qualified financial institutional investor, for short, QFI, we depended on quotas. So it was a closed local stock market, unlike India and many other markets. 2015-16, they changed that. They said no longer quotas required. You can buy these A shares through the Hong Kong exchange because Hong Kong is a part of China. Consequently, MSCI came forward and said, okay, now that the market is open, we are going to include these very important, great private businesses listed on the China exchange, which weren't available for foreign investors easily earlier, into our benchmarks, because those benchmarks are followed by ETFs, index funds, and frankly, even by active portfolio managers as a benchmark. So on the right-hand side, you will see that the MSCI, the third bar, is showing you the MSCI emerging market benchmark, which is where China is currently about 35% in total. 5% is local Chinese share. The other 30%, if you're wondering, are the Hong Kong listed shares or US listed shares, which are ADRs. So Chinese companies have the ability to list on the Hong Kong exchange, and they're called H shares. And of course, ADRs, just like Indian companies, which are listed as ADRs as well. But because A shares are now available, that 35% will jump up to 46%, an increase of 11% allocation to China. Now, there is a vast pool of capital which tracks these benchmarks and allocates according to these benchmark weights. If the allocation has gone up, no doubt the allocation to Chinese equities by these ETFs, index tracking funds, will have to go up. And similarly, we've given you on the extreme right-hand side the final two columns for the all-country world index, which is not emerging market, but the entire global market. China's currently 5%. It's expected to go up to 7%. Again, pools of capital that track that benchmark will have to allocate more to Chinese equities. Now, that's not the reason why you should invest. The reason you should invest is because fundamentally, this is an exciting region. There are going to be exciting opportunities. But on the left-hand side, we're just showing you, because of this legacy of the Chinese onshore market being closed, the foreign ownership is less than 5% of the total market. This is the second largest capital market in the world. Foreigners cannot keep their allocation to less than 5%. It's bound to go up over a period of time. Once again, it's an important and interesting concept to understand, but not the fundamental reason or driver for your decision to invest into the Chinese stock markets. It should be fundamental reasons. And hopefully, through our conversation between Niranjan and I and what I spoke about in the monologue, we've been able to express that as well. I'll pass back to you, Niranjan.
Thanks, Supreet. Before we end, just want to make one announcement, because there have been a lot of questions around NAV of the underlying fund not being published for last 3 days. Just make note that over the last 3 days, that is starting from 28th till 22nd, the underlying fund was closed for subscription, and it was a non-business day. today onwards, the NAV will start coming up. So if you have invested over the last 3 days, the NAV which will be applicable will be today's end of the day NAV, which will be declared in India tomorrow morning, 10:30 a.m.
It's a culmination of a perfect storm, right? All that was happening on Friday.
Absolutely.
Monday and Tuesday was Mid-Autumn Festival holidays in China.
Right.
And Wednesday was a holiday in Hong Kong.
Absolutely.
Because both China and Hong Kong are important markets, the fund just could not trade on those days because the markets are closed, and which is why Niranjan pointed out the first available NAV will come out today.
Yeah, thanks, Supreet, for clarification. And thank you so much, Supreet, for all the clarity and all those insightful points on the China market. I hope we have tried to address, and we were able to address most of the questions from our investors. Thank you so much for joining in today, and we look forward to speaking with all of you again. Thank you, Supreet, once again.
Thank you, everyone, and happy investing. Have a great evening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.